Here is a lesson on how disaggregating households in a computable general equilibrium model. Why is it interesting to disaggregate households in a computable general equilibrium model? The representative household assumption is statistically questionable because it is difficult to summarize with a single household an entire distributions of households with different sources of income, different income levels, and different uses of income in terms of consumption and savings. On the theoretical level, there may be biases with the representative household hypothesis. Indeed, if we can describe an economy at time t with a single representative household, it is not certain that with this structure we can capture a shock. For example, a positive shock on all incomes will have a very different effects on the poor and the rich households in terms of consumption. It is not certain that with a single representative household, the shock is well captured at the aggregate level. This requires homothetical properties that are often far from being verified by various functional forms of utility functions. It should be added that in the public debate, there are political concerns that constantly emerge, not only about the efficiency of a measure in terms of economic growth, for example, but also about its impact on the distribution of income. This is something that modelers cannot assess with a single representative household assumption. We are going, therefore, to introduce household categories that will be different from one another. They will differ from each other by their level of income, poor household versus rich households, by their source of income. We will have capitalists, skilled workers, unskilled workers, landowners, and they will differ from each other, finally, by the structure of their consumption. We are going to differentiate households in a simple way. It's just a matter of giving you a recipe that can be applied to different work directions. So I will consider 4 urban households, urban 1, urban 2, urban 3, and urban 4, and 4 rural households, rural 1, 2, 3, and 4. Of course, other differentiations of households are possible by source of income, capital versus skilled labor versus unskilled labor, and so on, by level of income. It is interesting to note that at the beginning of CGE models with disaggregations of households, many studies give the priority to the level of income. But this can be misleading, as in a case of a strong impact on the economy, household may move from one decile to another one, and so it means that the disaggregation structure is endogenous to the shock. By occupation, farm workers, civil servants, self-employed people, and of course we can have several criteria of differentiating household, for example locations and occupation. Aggregation of households will have a significant cost in terms of the statistics to be collected. In fact, with a representative household, we only need the total primary income of households, the total direct taxes on personal income, and the total final consumption. It is therefore quite simple. Whereas with a disaggregation of households, one needs the share of consumption of each category of household in the total consumption, represented here by a double entry table. The distributions of the income of each factor of production between the categories of households is also required, again represented here by a double entry table. Also needed are the number of households in each category, the share of remittances from abroad received by each category of household, the share of government transfers received by each category of household, and the share of each category of household in income taxes. It is therefore clear that the disaggregation of households requires the accumulations of statistics that are not necessarily easy to collect. Let us now present the changes in the modeling. These changes concern the origin of income, with the primary income equation and the disposable income equation, They also concern the use of income with the savings and final consumption equations. For primary income, we have two equations. One is called EQ_INC. In this equation, the total primary income of households INC is the sum of all categories of households of the product of the number of households per category, NH, by the income of a household in that category, INC H. Note that the variable ending in H is relative to a household. INCH defined over H is therefore the primary income of a household in category H, while INC is the total primary income of households. Then we have an equation of primary income formation for a household in category H. It is expressed as follows. The number of households in this category times the primary income of a households in this category equals the income of each type of factor times the share that this category of households has in this factor. We also include remittances in the primary income. The income of each type of factor is the product of the remunerations of that factor times the supply of that factor, except for skilled workers, where it is the product of the remunerations of that factor times the total demand for that factor by all sectors of the economy. This is because there is unemployment, and therefore not all the labor supply is used. With regard to disposable income, we also have two equations. One is called EQ_DISP_INC. In this equation, the total disposable income of households called DISP_INC is the sum of all households categories of the product of the number of households per category by the disposable income of a household in that category. We always have the difference between individual variables ending in H and macroeconomic variables with the same name without the H. And then we have an equation called EQ_DISP_INCH defined over H for the formation of disposable income of a household in category H, which is expressed as follows. The number of households in this category times the disposable income of a household in this category is equal to the primary income of this category of households times the number of households in this category, net of direct income taxes, but increased by transfers received from the state. Note that the category H household is taxed on its income at the rate ITR defined over H, and in case the public closure is such that the tax losses are compensated by an additional income tax called delta_ITR, the rate of this tax is increased by delta_ITR. On the other hand, household category H receives in total a share called share_T defined over H of total transfers of government to households. As far as savings is concerned, it's very simple. We also have two equations. One is called EQ_savings. In this equation, the total savings of household is the sum of all categories of households of the product of the number of households per category by the savings of a household in that category. Then we have an equation called EQ_savings H defined over H. It defines the saving of a household of category H, and it is expressed as follows. The saving of a household of category H is equal to the propensity to save of this category of households times the disposable income of this category of households. Let's continue to present the income use equations. For final consumptions of households, we have three equations. Households utility is a LES function. It is the equations U defined over H, which has the same structure as in the last program, but applied at the households level of category H. If this utility is maximized under budgetary constraints, you obtain the demand at the level given by the equation EQ underscore CH defined over I and H. Finally, the equation EQ underscore C defined over I defines the total consumptions of good I. It is expressed as the sum of the demand of each category of households. What are the other changes to the model? They concern the public sold equation. This is always equal to government revenues, that is to say, transfers from the rest of the world to government, plus direct taxes on households, plus indirect taxes on consumptions, plus taxes on imports, plus taxes on exports, plus taxes on factors of production, minus government spending, and minus government transfers to households. Here, household disposable income is expressed differently. It is the number of households of category H times the disposable income of households of type H. We also note that the tax rate, ITR, is individualized by household category. There are also changes in calibration. Look at this very simple way of calibrating the final consumption of each good by each household category, based on the total consumption of the good in question, and the parameter called share underscore C. You also need to calibrate the primary income of each household category H, taking into account the parameter called share underscore F. It should be noted that for skilled workers, because of unemployment, we don't include the supply but the total demand for skilled workers by all sectors of the economy. Last, once we have the primary income of a household of category H for all categories, we can calibrate the total primary income of households. Here is the calibrations of the direct income tax rate paid by the household of type H and the calibrations of the disposable income of households of type H. This calibration is evident from the data previously entered. The parameter share underscore IT defined over H is the share of direct taxes paid by households of type H, and the parameter share underscore T defined over H is the share of government transfers to households going to households of type H. With regard to savings, the total savings of households is calibrated on the data entered in the social accounting matrix. The saving of a household of type H is its disposable income minus its final consumption. Last, the propensity to save of households of type H is deduced from this. To calibrate the LES function, the minimum consumption parameter is calibrated using the parameters entitled LES underscore C min defined over I. Then, as we know the consumer prices, the final consumption of each good by each category of household, the minimum consumption parameters, the propensity to save of each household, and the disposable income of each household, we can calibrate the parameters called gamma. And finally, with this information, we can calibrate the utility of household of type H. It's worth noting that the parameters of minimum consumptions and the parameters gamma must take specific value that reflect price and income elasticity of consumption. This is something that we will discuss later. For the calibration of the public sold, be careful to enter the direct taxes paid by each category of household by the formula sum over the double product household tax rate H called ITR defined over H times the number of households of type H called NH defined over H times the primary income of the household of type H which is called INCH defined over H. There are a number of points to work on in this modeling, and you are invited to do so at your own pace, of course. What do we do with the unemployed? In our modeling, they receive nothing unless it is through government transfers to households, but this point is not necessarily clear. In fact, in this modeling, we assume a uniform income in each household category H. We can assume something else, for example, a normal distribution or log normal distribution. In any case, additional statistical information is needed. One can use a household survey, and from this survey use what is called a top-down approach. That is to say, insert the results of the model into the household survey to obtain very disaggregated results. With the top-down method, we have detailed information, but a strong criticism is that households do not react to price and income variations. So some economists fully integrate the household survey into the model. So if the survey covers 100,000 households, they put 100,000 different households into the model, and they model the behavior of this household, this 100,000 households, in terms of consumption and savings. So it's a very big model with many equations. Finally, there is the questions of price and income elasticities of consumption for each category of household. They are certainly different between a rich household and a poor household, or between a rural household and an urban household. Therefore, econometric estimates have to be made. This is the best option. Or results from the literature have to be used. And once these elasticities are known, minimum consumptions and gamma parameters can be calibrated to reflect these elasticities. So the minimum consumption and gamma parameters must be at level that represent a certain household behavior implied by the price and income elasticities of consumption. I ask you to make the following assignments. You have to use model C3M1V5 space eng.gms, which is accessible on the platform. And I ask you to complete the following assignment. You must apply a cancellation of custom duties on imports with a public closure such that an additional tax on consumption is levied so that the public balance and public expenditure remain constant, and an external closure such that the current balance remain constant. The result of the analysis must be interpreted on one page, and so you must analyze the impact of this shock in terms of income distributions and household welfare.